Welcome to Multnomah Group's quarterly market commentary for the second quarter of 2024. I'm Karen Sanchez, a senior investment analyst for the firm. At their June meeting, the Federal Reserve maintained rates at 5.25% to 5.5%. That's a position it has held since July 2023. The Fed forecasted one rate cut coming in the second half of this year and raised the possibility of 4 cuts coming in 2025. That's up from the 3 cuts they'd anticipated in earlier meetings. The Fed's preferred measure of inflation is the Personal Consumption Expenditures Index, excluding food and energy. The PCE index accounts for both consumers' direct spending and expenditures made on their behalf, such as employer-paid insurance benefits. The core PCE inflation rate for the prior 12 months came in at 2.6% in May. That's down from 2.8% in April. The price of goods dropped 0.1%, while the cost of services increased by 3.9%. The U.S. economy rose at an annualized pace of 1.4% in the first quarter. That's a significant slowing from the last quarter of 2023, in which GDP rose by 3.4%. The first quarter number reflected decreases in consumer spending, exports, state and local government spending, and federal government spending. Gains in residential fixed investment and imports partially offset these decreases. The surveys of consumers from the University of Michigan gauges consumer sentiment on personal finances and the general economy's short and long-term health. July's report showed that overall consumer sentiment was down 7.7% from 1 year ago. While inflation expectations are softening, consumer sentiment on economic health declined 16.2% over 1 year ago. This is as the election cycle focuses more consumer attention on their personal and government finances. Turning to fixed income markets, the Bloomberg U.S. Aggregate Bond Index returned just 0.1% for the second quarter. Cash and high-yield debt had the best returns, up 1.4% and 1.2% respectively. Developed international bonds, long government credit, and investment-grade corporates declined, down 3.9%, 1.7%, and 0.1% respectively. The yield curve is flattened somewhat from 1 year ago, but remains modestly inverted, with the yield on 2-year treasuries at 4.7% and the 30-year yield at 4.5%. The 10-year treasury yield was 4.4%. Yields continue to move in anticipation of Fed interest rate changes. The S&P 500 index was up 4.3% for the quarter, and the 1-year return was up strong at 24.6%. Positive returns in the second quarter came from just 5 of the 11 sectors. Information technology led returns up 13.8%. Communication services came in second, posting a return of 9.4%. 6 sectors posted negative returns, with materials down the most at negative 4.5%. Led by large cap technology stocks, large cap growth saw the best return among the asset classes in the second quarter, up 8.3%. Small value posted the worst return, down 3.6%. Large cap growth led the 12-month returns as well, up 33.5% for the period, while small cap growth posted the lowest return, up a relatively low but still healthy 9.1%. Index concentration continues to be a major story. The top 10 stocks of the S&P 500 index comprised approximately 1/3 of the index on a cap-weighted basis as of June 30th. For the quarter, these companies returned an average of 14.3%, besting the index return by 10%. Berkshire Hathaway and Meta were the only laggards, underperforming the index by 7.6% and 0.3% respectively. NVIDIA, 5.7% of the index, continued to lead the broad market, up 36.7% in the second quarter. Emerging markets outperformed U.S. equity and developed international equities markets in the second quarter, posting a return of 5.1%. The MSCI All-Country World ex-USA Index, which includes emerging markets, returned 1.2%. The MSCI World ex-USA Index, which excludes emerging markets, posted a return of negative 0.4%. Among the emerging markets economies, Asia posted the highest return, up 7.5%, while Latin America underperformed by 12%. Among regional developed international markets, Japan posted the lowest return at negative 4.2%. Turning to the outlook, citing economic factors, the Fed has maintained interest rates at a recent high of 5.25% to 5.5% since July 2023. Employment remains strong, and inflation, while moderating, has not yet reached the Fed's preferred level. As of the June meeting, the Fed forecasts one rate cut coming in the second half of this year, while market consensus holds open the possibility of a second cut coming in December. The Fed is also open to the possibility of further rate cuts coming next year. Their next meeting will begin July 30th. Many consumers have a negative view of their finances and the economy, as outlined in the University of Michigan surveys of consumers. Outcomes have been mixed as the average consumer saw higher inflation than wage growth, and housing affordability declined. However, the consumer is still in a strong position with unemployment at 4.1%. There is $800 billion in excess savings remaining after the stimulus bumps of 2020 and 2021. Household debt as a percentage of income is at 9.8%, and while rising, it is still below pre-pandemic levels. Market index concentration has increased as the weight of the top 10 companies in the S&P 500 index increased to 37%. However, the performance of 2023's market leaders, the Magnificent Seven, has seen some dispersion in the year-to-date. NVIDIA outperformed the S&P by 134.2%, and Apple's growth slowed, lagging the S&P by 5.6%. This comes as last year's excitement about the possibilities of artificial intelligence moderate. Tesla's recent troubles led it to underperform the S&P by 35.7% for the year to date. Election years can be volatile as markets and consumer sentiment swing on potential outcomes. It's important to note, however, that elections have historically had little impact on subsequent market returns. These returns are far more correlated with economic cycles.